Have you ever contemplated the real essence of equity in finance? If you've ever pondered this question, you're not alone. Today, we're going to unravel the enigma of equity, a term that's often thrown around in the financial world, but rarely fully understood. So what is equity? In the simplest terms, equity refers to ownership. In a financial context, it's the value that would be returned to a company's shareholders if all the assets were liquidated and all the company's debts were paid off. It's the difference between what a company owns, its assets, and what it owes, its liabilities. Imagine you're baking a cake. The ingredients you've purchased, the flour, sugar, eggs, and butter, are your assets. But you borrowed some of those ingredients from your neighbor. Those borrowed ingredients represent your liabilities. The remaining ingredients, the ones you actually own, that's your equity. Equity is the foundation of the balance sheet, one of a company's most important financial statements. A balance sheet is like a snapshot of a company's financial health at a specific point in time. It's divided into three main sections: assets, liabilities, and shareholders' equity. The assets are everything the company owns, the liabilities are everything the company owes, and the equity is what's left over for the shareholders. It's a simple equation. Assets minus liabilities equals equity. But don't let its simplicity fool you. This equation is crucial in determining a company's financial health. A company with positive equity is generally considered financially healthy, while negative equity can be a red flag for potential investors. So why is equity so significant? Equity represents the real value of an investor's stake in a company. It's a measure of a company's net worth and a key indicator of its financial stability. Equity, as we've discovered, is a significant component of a company's financial health. It's more than just a number on a balance sheet. It's a reflection of a company's past performance, present condition, and future potential. Equity carries a range of advantages that might be beneficial to both companies and investors. From the perspective of a company, one of the most compelling advantages of equity is that it does not come with an obligation to repay. Unlike loans, which require regular payments regardless of the business's financial health, equity allows companies to utilize the invested capital without the pressure of repayment schedules. This flexibility can be especially beneficial in times of financial instability or during the early stages of a business, when cash flow might be unpredictable. Another advantage of equity is that it can help maintain control and ownership within the company. When a business takes on debt, the lenders often require a degree of control over business decisions. In contrast, equity financing allows the original owners to maintain their decision-making power, fostering a sense of ownership and commitment. From an investor's viewpoint, equity carries the potential for high returns. Investors in equity essentially become part owners of the business, sharing in the profits and growth of the company. If the company does well, the value of the equity investment can increase significantly, offering a return that can far outweigh the initial investment. Equity also has an influence on company culture. When employees own equity in the business, they are likely to feel more invested in its success, which can promote a culture of collaboration, innovation, and commitment. This sense of ownership can drive performance and contribute to the overall success of the company. But it's important to remember that while equity can offer significant benefits, it also involves certain risks. Investors take on the risk of the business failing and must be prepared for the possibility of losing their investment. Similarly, companies that offer equity are giving away a portion of their ownership, which can lead to loss of control if not managed carefully. Equity can be a powerful tool for growth and expansion, but it does not come without its own set of challenges. While equity can be a boon, it also carries certain drawbacks that one needs to consider. Let's delve into a few of these disadvantages. Firstly, there's the potential loss of control. When a company issues shares to raise capital, it essentially sells a portion of its ownership. This might not be a concern when only a small percentage of equity is sold, but as more shares are issued, the original owners may find their control diluted. They could even risk losing majority ownership, and along with it, their ability to steer the company's direction. Secondly, there's the obligation to pay dividends. While not mandatory, shareholders often expect a portion of the company's profits as dividends. This can put financial pressure on the company, particularly during lean periods when profits are low or non-existent. It's a balancing act between retaining enough profits for growth and satisfying shareholder expectations. Next up, we have the dilution of shares. When a company issues additional shares, it dilutes the value of existing shares. This means the slice of the pie each shareholder owns becomes smaller. While this isn't necessarily a problem if the company's total value increases, it can lead to disgruntlement among existing shareholders if not managed properly. Lastly, there's the risk of making losses. Equity investors bear the risk of the company's performance. If the company does not perform well or goes bankrupt, equity investors stand to lose their entire investment. This is in contrast to debt investors, who have a higher claim on the company's assets and are more likely to recoup a portion of their investment. These disadvantages don't mean equity is a bad choice. It simply means it's not a decision to be taken lightly. It's crucial to understand the implications and manage the potential risks. After all, with greater risk comes the potential for greater rewards. These are the risks and challenges associated with equity that every investor and company should be mindful of. How does equity function in the real world, and what does it mean for you? Well, let's take a look at some real-world examples. Say you're a homeowner. The equity in your home is the difference between the market value of your house and what you owe on your mortgage. If your house is worth $200,000 and you owe $100,000, you have equity of $100,000. This is a tangible asset that you can leverage for loans or sell to realize the value. But equity isn't just about home ownership. Consider the world of business. Companies often raise money by selling equity, otherwise known as shares, in their business. If you buy shares in a company, you're buying a piece of that company's equity. This can be a powerful tool for businesses to raise capital and for investors to potentially reap rewards if the company grows and increases in value. Now, let's expand our view even further to the broader economy. Equity affects economic stability and growth. When businesses have access to equity financing, they can invest in growth, creating jobs and driving economic activity. On the other hand, when equity markets are volatile, it can lead to economic uncertainty. Let's not forget about personal finance. Equity plays a crucial role here too. Your personal net worth is essentially your personal equity, the value of what you own minus what you owe. Understanding and managing your personal equity is key to financial health and long-term wealth building. So what does all this mean for you? Whether you're a homeowner, an investor, a business owner, or just someone trying to manage your personal finances, understanding equity can help you make informed decisions and potentially improve your financial situation. As we can see, equity is not just a concept, but a reality that affects us all. So, what have we learned about equity? Throughout this journey, we've unraveled the enigma of equity, a concept seemingly complex, yet at its core, simple and fundamental. Remember, equity represents an ownership stake in a company. When you own equity, you own a piece of the pie. It's your slice of the company's assets and earnings, your claim to a portion of the profits. We've seen that equity carries with it numerous advantages. It's a vehicle for growth, a tool for expansion, a means to fuel innovation. Equity can provide companies with the capital they need to embark on new ventures, to explore uncharted territories, to take the risks that can lead to transformative breakthroughs. And for investors, equity offers the potential for substantial returns, the chance to share in a company's success, to reap the rewards of its triumphs. Yet, we've also acknowledged the disadvantages of equity. Ownership is a double-edged sword. As an investor, you share not only in a company's successes, but also its failures. Your investment can shrink, even vanish, if the company struggles or fails. For companies, issuing equity means giving up a slice of control. It means answering to shareholders, navigating their expectations, balancing their interests with those of the business. In the real world, equity plays a pivotal role. It's a driving force in the economy, shaping investment strategies, influencing business decisions, impacting wealth distribution. It's a tool that can be wielded for good or ill, a power that can be used to build or to destroy. And thus, we circle back to the beginning, to the simple yet profound concept of equity. It's not just a financial term or an investment strategy. It's a reflection of our values, our aspirations, our choices. Equity, with its benefits and challenges, remains a cornerstone of finance, shaping the way we invest, grow businesses, and even view wealth.